Hello everyone, I'm Hao Chen and I will bring you the vertical analysis of income statement and balance sheet for Tiger and Lions Company. The main focus of vertical analysis is to represent each line item in the financial statements of Tiger Company and Lion Company as a proportion of the underlying amounts of total assets, liabilities, or equity. Unlike a horizontal analysis which tracks a company's financial performance over several years, a vertical analysis focuses on a single period. This makes it easier to understand for anyone who wants to understand how various factors affect the company's overall financial health. The common size balance sheet makes it easy to make comparison between companies because it converts every item on the balance sheet into a percentage of a base. This technique is used to access key aspects of performance and therefore aids the decision making. These include budget allocations, cost containment efforts, capital investment projects, and revenue growth strategies. So as we can see in the table 1, the main cost center for both Lion and Tiger Company is cost of goods sold, which suggests that both companies may be in the retail industry. The COGS ratio is 73.83% for Tiger and 71.91% for Lions, suggests that there may be various opportunities for cost cuttings in these industries. The operating expense to net sales ratio of Tiger Company is 14.62%, while that of Lion Company is 15.16%. In addition, the two companies' operating expenses as a percentage of revenue are quite close, 15.16% of revenue for Lions and 14.62% for Tigers. The proximity between the two means that they allocate almost equal shares of resources to operational functions, and a slight difference could mean that different strategies are being used to control expenses or manage overhead cost. In addition, by examining these expense ratios and other important data, companies will be able to improve profits by focusing on specific operational improvements rather than only on sales revenues. Table 2 shows that the property, plant, and equipment PPE form the largest portion of total assets for both Tiger and Lion Company. Tiger's PPE represents 46.3% of its total assets, while Lion's is even higher, indicating significant capital investment for both companies. Unlike likely aimed at future returns, Tiger's prepaid expenses are 2.54% of total assets, slightly more than Lion's 2.19%. Lion's smallest asset is note receivable, only at 1.95%, while accounts receivable are higher for Tiger at 20.18% compared to Lion's at 15.31%, suggesting both could improve receivables management to boost liquidity. For liabilities and equity, Tiger's liabilities are 48.02% with share capital at 34.81%, while Lion's liabilities are lower at 41.33% and share capital at 30.63%. Both companies rely more on debt than equity. Lion has high retained earnings, 28.04% than Tiger's, where it's 17.17%, placing it in a stronger position of reinvestment and growth.
Hello everyone, today I'll be presenting on the topic financial ratio analysis of Tiger and Lion companies. We will be comparing two companies, Tiger and Lion, using financial ratio analysis. This will give us insight into their financial health and operational performance across several categories like liquidity, solvency, efficiency, profitability, and market ratio. We'll explore how these ratios provide us with a better understanding of the strengths and weaknesses of each company. Now we'll be looking at liquidity ratio. Liquidity ratio measures a company's ability to cover its short-term obligation. It is a crucial measure of financial stability. We will be calculating working capital, current ratio, and quick asset ratio. Working capital for the Tiger Company, working capital is $114,700, whereas Lion Company has slightly lower capital than Tiger Company, that is $111,100. Both companies have positive working capital, indicating they can cover their short-term liabilities. Now, current ratio. Tiger current ratio is 2.27, whereas Lion current ratio is 2.15. A ratio above 2 is typically considered healthy, meaning both companies are well equipped to handle current liabilities. Quick ratio. Both companies have an equal quick ratio of 1.20, which excluded inventory from current assets. It indicates that without selling inventory, they can still meet short-term obligation. Now let's talk about the solvency ratio. Solvency ratio evaluates a company's long-term financial health by measuring the extent to which its assets are financed by debt. Debt ratio. The Tiger debt ratio is 0.48, meaning 48% of its assets are financed by debt, whereas Lion is slightly lower than Tiger Company, which is 0.41, that is 41%, suggesting Lion has a healthier balance sheet in terms of debt management. Debt to equity ratio. Tiger debt to equity ratio is higher at 0.92 compared to Lion Company, that is 0.70, which shows Tiger is more leveraged than the Lion Company. Time interest on. This ratio indicates how many time a company can cover its interest expenses. Tiger has a ratio of 7.70 while Lion has 7.02. This means both companies can comfortably cover their interest expenses.
Hello everyone, it's Sharmila Man. Thank you Ranjita for explaining about liquid ratio and solvency ratio beforehand me. Moving on, I'll be explaining about efficiency ratio. Efficiency ratios. To briefly talk about efficiency ratios, it shows how effectively a company manages its assets to generate revenue. We'll be calculating accounts receivable turnover, days sales in receivables, inventory turnover, and total asset turnover under efficiency ratio. So basically we'll be calculating and comparing between Lion and Tiger Company. First hand we'll have calculated accounts receivable turnover. Tiger has a turnover of 4.89 while Lion has a much higher turnover at 8.74. This suggests Lion collects its receivables much faster than Tiger. Next on, we have calculated days sales in receivables. Tiger takes about 75 days to collect on sales, while Lion takes 42 days, showing Lion's stronger collection efficiency. Thirdly, we have calculated inventory turnover. Tiger has an inventory turnover of 3.03 compared to Lion's 5.91, meaning Lion is quicker in converting inventory into sales. Finally, we'll be calculating total asset turnover under efficiency ratio. Lion is more efficient in using its assets, which a turnover of 1.45 compared to Tiger's, which is 1.03. Continuing on calculation, next on we're moving to next slide, which will be profitability ratio. Let's talk briefly about profitability ratio. Profitability ratios measure how effectively a company generates profit relative to its sales and assets. We'll be calculating gross profit margin, net profit margin, return on total assets, and return on equity under the profitability ratios. First hand, we'll be calculating gross profit margin. Tiger's Gross profit margin is 26.17%, while Lions is slightly better at 28.09%, which indicates Lion generates more profit from each dollar of sales. Next one we'll be calculating is net profit margin. Tiger's net profit margin is 8.60% and Lion is 9.24%, which indicates Lion retains more profit after taxes. Moving on, we'll be calculating return on total assets, which is also known as ROA in asserted term. Lion has a significantly higher ROA at 16.07% compared to Tiger's 10.35%, showing Lion is more effective at generating returns from its assets. Next on, we'll be calculating return on equity, which also known as ROE on SERDA version. Lion also outperforms Tiger in ROE with 20.69% compared to 18.72%, meaning Lion generates better returns of its shareholders. Next on, we'll be explaining about market perspective ratios, where we'll be calculating price earning ratio and dividend yield of Tiger and Lion Company and their comparisons. So to talk about market perspective ratios help us understand how investors value the company. Let's calculate price earning ratio for Lion and Tiger Company. Tiger has a price earning ratio of 19.69, indicating investors are willing to pay almost 20 times its earnings per share compared to Lion's lower price earning ratio of 13.70. This suggests Tiger might be viewed as a growth stock. Moving on, we'll be calculating dividend yield. Both companies have a dividend yield of 6%, meaning they offer an identical percentage return on dividends relative to their stock price. Thank you. That is all from my end. Next on, Bruna will be the one presenting for the rest of the presentation. Thank you.
Hello, Professor Jerry. It's Bruna here, and I'll begin the presentation by discussing part 3, focusing on key points regarding the financial health of the Tiger and Lions Company Group: liquidity, solvency, efficiency, flexibility, margin analysis, and finally, the conclusion. So the next slide, the first one is liquidity. So as we can see, both Tiger and Lion are in strong positions to meet short-term obligations, and Tiger holds a slightly advantage with a current ratio of 2.27 versus Lion's 2.15, but both have identical P2 radios at 1.20, showing they can meet immediate liabilities without relying on inventory. The next one is about solvency. And solvency, Lions shows better long-term financial stability with a lower debit ratio of 0.41 compared to Tigers, 0.48, and more conservative debit equity ratio of 0.70 versus Tiger 0.92, while Tiger adds outlier in interest coverage. Lion's overall solvency is stronger due to its lower debit reliance. The next one is about efficiency. And about efficiency, Lion outperforms Tiger across all efficiency metrics. And Lion turns over receivables and inventory faster and has a higher assets turnover, indicating more efficient use of its assets to generate revenue. And now profitability. And Lion leads in profitability with a gross margin of 28% and a net margin of 9%. And compared to Tiger's 26% gross and 8% net margins. So additionally, Lion has significantly higher returns on both assets and equity, reflecting a stronger financial performance. And now we are going to talk about marketing perspective ratios. And in this topic, Tiger Tiger's higher rate of 19.69 suggests higher growth expectations, but Lion's lower rate of 13.70 may offer better value for investors. So both companies provide the same dividend yield of 6%, giving shareholders equal returns through dividends. And now, the conclusion. And based on this analysis, the conclusion is, in overall, Lion is the stronger company and it excels in efficiency, profitability, and solvency. And while Tiger only holds a slight edge in liquidity and marketing expectations. So Lion's conservative financial approach and its stronger profitability make it better investment option. So for now, that's it, Professor Jerry. Thank you very much. Bye bye.
Based on the evaluation of the part 3, Lion's company shares are recommended as a better investment because Lion demonstrates a stronger financial health across key metrics, which are including lower debt levels, which enhances long-term stability and higher efficiency ratio, and indicating a higher effective use of resources. And moreover, Lion's profitability is much better in ranking, with the higher profit margins and better returns on assets and equity. And its lower price to earnings, which is PE ratio, suggests that the stock is undervalued and offering a more attractively priced investment compared to the Tiger one. Overall, Line provides a more balanced and sustainable options and making it preferable choice for the investors.